What's going on, everybody? Welcome back and welcome to lesson 2 of the Liquidity Precision System. This whole series that we're going to be doing for our team is literally my brain work and framework of how I blended some ICT concepts. So we want to go ahead and start off because this might wander on YouTube. So we want to give credit to where credit's due. We want to give credit to some of the supply and demand concepts and ICT concepts, and I blended it and I made it a simple and easy framework. But before we get into the cool things and the recordings and trading with these massive amounts and jumping from thing to thing, we have to understand the foundations. And the first part of this foundation is the multi-timeframe analysis tool, because this is your top down. So again, I ask that you take notes, make sure you have your questions for the end, and this will be recorded. If you're in the private mentorship, I haven't named it yet, or if you're one of my gold members, you will have access to this inside of the main chat. Okay. All right. So here we go. Disclaimer. Long story short, trading's risky. Make your own financial decisions. Now, the agenda for today, we're going to go ahead and introduce some concepts to the program. Some of you guys are gold, and you've been trading alongside with me every day. So this may be slight review before we get going, okay? So it's going to be slight review for the gold members. Now, as we kick off, we had lesson 1. So guys, again, if you go inside the Discord, if you're gold and you scroll down, we have a ton of lessons here from the old program. And again, this new program, though, there's only one concept that's being added. It's just cleaner framework. But you can find here the PDFs. There will be PDFs with every video. You can find it here in the Liquidity Precision System. Right now, I haven't adjusted the permissions for this channel, so please don't comment in it. But everything will be downloadable here for your needs, okay? So the first lesson's already there. So make sure if you haven't seen it, go watch that first lesson. Now, going back to it, we're going to go pick up a small review from the first lesson. We're going to give an overview of MTF. We're going to talk about ERL and IRL. These are concepts that are core and that's fundamentally needed. Time frame alignment, the proper time frames, and each time frame has a set of rules before I hit the buy button, right? And then we're going to go over a live trade example. So sit back and relax. So this is part 1. And part 1, we went to we actually combined PD arrays and market structure in this section of the course. I will be adding more lessons as I see fit, as we reciprocate the material that we give to you. Okay. So in our last lesson, we covered straight market structure and PDs arrays. So we're going to pick exactly up where we left off. So what I want you to do is, if you're watching this, pause the screen and draw out everything you've learned in the market structure lesson. Draw out all the PD arrays, draw out all where price is going. Give me some form of analysis here on this chart that you can form a direction that you learned in the first part. So pause this now. Okay, you unpause and we'll show you. But for those of you that are here with me, obviously you can't pause the screen, all right? So just sit and watch. Here's what you should have. Now, there's a sell side of the curve, but we've switched to the buy side of the curve. So analyzing this particular time frame, we see the market structure shifted. You see price respecting the PD arrays are here. This is the right side of the order flow. You see this is also a bullish fair value gap. Price comes into it, and there's a theory called ERL and IRL, which we're going to talk about later. But all of this order flow is being respected. You have the market structure shift, and then you have the draw of liquidity higher. So obviously, we have a strong bullish bias, and we're going to be favoring bullish setups in this particular environment. Now, here's the issue. If you just watch one lesson and learn all that, you can't really go to apply that to the chart, because you need to look at the market from a top-down approach. If this is the 5-minute chart, how do you know which direction the 1-hour chart is, right? Theoretically, in my opinion, if you're trading with one time frame and you're only watching one time frame, you might as well be trading blind, right? And to compare that to what it is, if you go across a 4-way intersection, work with me now. You go across this 4-way intersection. Are you only going to look one direction and walk across the intersection? You're going to look left. You're going to look right. You're going to look across the street. You're going to look behind you, because you don't want to get hit, especially if it's dark and visibility and conditions aren't clear. You might try it once or twice, just walk across the street with a blindfold on and just don't look left. I mean, I don't expect your life expectancy to be as high. Point of the matter is, why would you not apply that to trading? How much better would your positions be? How much more likely will your positions are able to win when, if you're looking for a bullish setup, in the daily, the 1 hour, the 5 minute, the 10 minute are all in the same direction or have some type of bullish concept being applied across all these time frames. That would skyrocket your win rate because theoretically you're waiting for the right conditions to trade instead of trading every day. Next is when you have this type of analysis, you're more disciplined. You're looking at the chart from a perspective of price needs to be like this in order for me to trade. Price needs to come to me in order for me to trade, because without it, you lack framework. And if you lack framework, the ability to go on tilt becomes very high. The ability for you to make a mistake and fall subconscious to your emotional frame behind the markets becomes very high without this kind of time framework. So again, this is the same time frame, right? So if you look at this and say, I'm only going to use this time frame, where are you going to put your stop at? If this is the highest time frame, it's going to be too wide. If you go to the lower time frame, this is a 1 minute chart, where's the direction at? So the answer to it is combining what every time frame is doing to form a uniformed analysis. So MTF, multiple time frame analysis, is a technique to analyze the same asset groups across a couple different time frames. We want to identify the trend, and we want to pin the trend, the PD arrays that are on that trend, and where the price is likely to go based off liquidity. If we can find all of that, we can effectively build a narrative for where price should go. Okay. So why MTF? MTF, because obviously we don't look at the 1 minute chart and make a whole story off the 1 minute chart. We want to see context via multiple time frames showing us that we're bullish or bearish, depending on your situations. The thing I want you to really realize about MTF, and the more important part about MTF, is that the lower time frames are noise. You might see me as a streamer executing on the 1 minute time frame, but I'm executing oftentimes from a 1 hour area, a 15 minute area. I'm not just looking at a 1 minute chart and just adjusting to where I'm going. The lower time frame is noise until you have narrative. And in fact, every candle is noise until your model says go. Somebody should quote that. The lower time frames, they just confirm the higher time frames order flow, right? So concept that you want to learn, and this is where you want to start to pay attention. The first one is going to be called internal and external range liquidity. If you're trading with us live, I will be talking about this every day at 9:10 on live stream. I'm there, right? And I'm going over what chart we're looking at, and I'm speaking to you in this language. Part of my goal in this course is to get everybody that is here, the new ones, the more experienced ones, at a place where we can speak to each other and effectively shoot out what we're doing faster so that everybody can be a part of the fun, okay? So getting into it, external range liquidity and internal range liquidity are two concepts in understanding where the market, how the market's going to move. ERL, internal range liquidity for short, is, long story short, the pending stop loss orders that the market's going to look to manipulate. Now, the market itself, in my opinion, like Warren Buffett says, is a device from the patient to the impatient, and they do that in forms of manipulation. You would see that when you start to go through this course, a big part of what I do is liquidity. So just because price is going somewhere, if the overall higher time frame trend has an area of liquidity, the market's more likely to manipulate that area, okay? And this is how they usually do this, right? IRL is once you form a range, once you expand, we're going to get to charts, and we're totally going to talk about this behind screens. But when you look at a chart and you look at an uptrend, when we do the break of structure higher, and again, break of structure from the last lesson. But when we do the break of structure higher, we're taking out those sell orders that sent that retracement in. The IRL happens once that BOS happens. Once that BOS happens, you effectively have a range. And I call that a leg of expansion. I'll promise when we get behind the charts, you're going to totally understand exactly what I'm saying. And then when you rewatch these lessons while you're studying, go back and forth and look at this concept and the chart behind it. But understanding the relationship is what honestly will give you an edge. So here are clear examples. Liquidity of an ERL is whatever exists beyond recent highs and recent lows. That means stop loss clusters, pending orders where people are likely to get in at, people that have stop losses at the top of the trend. That area, that's external range liquidity. So it matters because we know where they're going to go. And we want to, most importantly, not put any stop losses there. But again, we'll talk about that because you can get swept. And we want to use this as a target. So here's a chart. It's not a chart, but here's a line graph. In this particular line graph, let's get a pin. I get a pin. You see that price is going higher. Now, when price gets to its top point here and retraces, there's going to be something in here, and it's going to bounce from here. We'll talk about this something here in the next slide. But once we turn around on this particular area, the stop loss orders here is what we're going to target, and that's your ERL. Okay. The internal range liquidity is pretty much the opposite. Think of the ERL at the top, the internal in the middle, and if you lose the internal, you're looking at a reversal. Jim, you should write that down. But this is located within the current price range. And what that's going to be is usually some form of PD array, which we talked about in the last lesson. Your type of order blocks, your fair value gaps, your inversion gaps, breakers, whatever it may be that's inside the range, because every situation given to you is going to be different. I wish I could tell you every chart looks the same and every entry point is the same. But realistically, the market's going to throw something at you, and your job is to apply this logic to what it's throwing at you, okay? But any PD array, even including volume imbalances, this is important because this is where, long story short, institutions will likely re-enter, because a big portion of the market after it finds liquidities is to seek inefficiencies. So because an inefficiency is nothing more than an imbalance in a way. So because we take external, price is going to look to fill that gap if we're in a clear uptrend, right? We want to align our trades and zones. I call zones POIs. POIs are points of interest. Zones, they're the same thing in my opinion, because you're drawing a zone on your chart. But we use those areas from that model to give us precise entries. So here's the IRL. So if this is the ERL up here, price is going to pull back into something. This something, when I say something, it's going to pull back into some form of PD array. It could be the inversion gap. This case is a bullish fair value gap. Price does the ERL draw. This is ERL. Price takes that ERL, right? And it leaves open this liquidity. Now, when we start talking about defined ranges and all these names for ranges, right? We're at a point where everybody's creating content. And then in my eyes, this low, this high, when we get to LAF, that concept, this is one concept right here, becomes very important. But this low and this high, that's your confirmed range. This is your main range. Most people, when they're talking about ranges and drawing stuff, they're talking about this high and then this low. I just call it my leg of expansion, because this is the leg that took ERL. So when price starts to pull back, again, this is a volume imbalance. That's IRL. So we go from ERL to IRL back to ERL. In this case, we formed an order block. Price pulls back into that area. Together now, fair value gap to ERL, price pulls back into the volume imbalance. From the volume imbalance, price goes to ERL. And that cycle repeats. Here's a real chart. I know some people's like, show me a chart. Here's a chart. Price makes this high. Inside of this low and that high, you have the internal draw, which is this bullish fair value gap. If you don't know the fair value gap, go back and watch lesson 1. This high is formed. And between this low and this high, your new ranges pulls back into internal and goes, right? What's also going on the chart? Market structure shifted. You got to draw off liquidity higher, and price is going to walk its way there. And knowing that these internal areas are more than likely to turn price around, we can zoom in on the lower time frames and figure out when that time frame shifts, and that to give you an advantage of getting into that directional bias trade. This cycle just repeats all the time on every time frames. Now, sometimes price is aggressive. Things are going on. News are coming on. There are things that will make certain concepts in that area go back and forth from particular win rates. But for the most purposes, the majority of the action you're going to see, this theory is just going to repeat itself over and over and over again. Think of it as like one of those things that goes back and forth, back and forth, back and forth. That IRL, ERL is just the market taking liquidity and rebalancing inefficiencies. And that's why it's so powerful. Now, when we have that concept there, now we start talking about applying that same concept across multiple time frames. Because as I said before, if you're only watching one time frame, you might as well just be trading blind. So the proper time frame alignment for us as day traders, because in this portion, I'm not just showing you something and I'm not doing it. I'm actually trading live next to you, trading exactly these concepts. I'm showing you my entries. I'm even executing in front of you. So this whole mentorship is about how I'm doing what I'm doing on the screen. Now, proper time frame alignment is important because the daily will give you directions, but the entries are too wide. The 1 minute to give you entries, but there's no context or narrative. True precision comes basically when we can align everything and everything works out together. And that's why we want to have bias context in a lower time frame as sniper entries. So we have a higher time frame. I like the daily time frame of define bias and somewhat give me context. I judge context in general by what the middle time frame, which is my 1 hour. You're going to see me trading on, like if you was in today's live stream, I'd bounce back from the 1 hour to the 1 minute, back to the 1 hour to the 1 minute so many different times, because that's going to give me more of a where we're at right now. The daily time frame may be bullish, but where's the more 1 hour structure doing? Because I'm trading on such a low time frame, that 1 hour structure becomes more of my guide. If the daily chart if I couldn't for whatever reason use the daily chart, I would still be able to apply my strategy with just a 1 hour chart. But without that extra confirmation, we're sized down. And we will talk about that in 1 second. Now, the lower time frame is the entry time frame. It should be LTF, but ETF, same thing. And that's usually going to be between a 5 and a 1 minute time frame. I don't go sub 1. I know some people do that on Twitter. You can have fun with that. I'm only trying to trade once or twice a day. I only want to go to the 1 minute chart. Okay. So this works because the higher time frame is going to tell you the story. The middle time frame is going to give you the structure, and the lower time frame is going to give you the precision. Coming into the day every day in the pre-market huddle at 9:10 in the morning, I'm showing you how I arrived to this conclusion. So this is a great lesson. And honestly, if you guys want to take your understanding to the chart, when you watch this lesson, when you watch the first lesson and you watch this lesson combined, you now have tools to analyze the chart in a very precise way. So if you really want to take your lessons, your trading to the next level, pause the screen and in the main chat, upload whatever day it is, current day, upload a chart with what you know now. Now, highest time frame, your HTF, this would be a daily chart. All we want is that external high, that external range liquidity. That's the high we want to mark off, and what's internal. If you can find that, if your overall structure is bullish and you have somewhere to target up top, this theory, when these three things happen, trend, draw of liquidity, PD arrays. When that happens, you're in a market that's giving you sauce. That market's going to pay you a lot. And I haven't really heard anybody talk about why certain concepts don't work. What is really your advantage and condition-wise that will say, I'm going to size up? For me, when I see the trend higher on a higher time frame, I got to draw liquidity higher, and I got some PD arrays going. I'm going to look for this theory, and I'm going to search for that IRL. We're going to take it down to a 1 hour chart. I'm going to do this live together here in a second. And you want to point out, where's that same, this is the daily area, right? They're both the daily area. Very important to understand when you go to mark up your charts, the stuff you put on the daily time frame, make sure you put it on the 1 hour time frame, right? So take that internal range, overlap it with the 1 hour range, and we want to see if we can confirm some type of market structure shift. We're going to talk about that. And we're going to talk about that here in a second. And then the PD arrays from here are the points of interest we're going to use on the lower time frame. Twitter is always going to tell you 1 hour, 5 minute. But I have tons of trades and back tests that'll show you 1 hour, 1 minute. And I can do it accurately and quickly. You're going to learn here in a little bit. But this is the framework that you want to have going into the day. The higher time frame is your roadmap. It gives you the overall narrative, trend direction, key PD arrays, and draw of liquidity. Always ask yourself what the higher time frame's telling you. All right. So again, when you're lining your time frames up, you want to, and again, we're about to get into a live trade example. You want to make sure you have the IRL and ERL on the chart. You want to identify the trend and find the draw. And your middle time frame, again, this is your most important time frame. This is my execution context as a day trader. I'm not going to hold a trade for 8, 20, 40 hours. I'm probably going to be out that trade as soon as 1 minute. And I can take that trade all the way to 2.5 hours. Now, do I go longer than that? Yeah, there's been times I've actually held trades from AM to PM session. But at the end of the day, I like to be cash. No risk of swinging, no Trump tweets, no, back in the day, Kim Kardashian did something with Snapchat and then their stock went down. Like, no nonsense. I'm at peace at night. And this is why understanding that my goal is to be out at night is to understand that I don't need the daily as much as I need the 1 hour. It also helps to filter out the noise. So sometimes, like we were saying, when is the best time to have the right conditions to trade? Is when these things align. Sometimes the 1 hour chart will clean up and shift structure and give you that direction you need. Think of this as the heartbeat of your daily sessions. Now, how do we get better odds in our favor? When the daily chart's bullish and the MTF, the 1 hour chart, when we're both bullish here, I'm only looking for bullish setups on a lower time frame. I can get a bearish setup and I can say, hey, I'm counter trend. You can go, size against that, but I would not recommend doing that. I'd recommend sticking with the actual strategy to the fullest potential of that strategy and trade less. In fact, I'm looking to trade less. That's why I'm trying to stack odds in my favor. And when they're both bearish, we want to look for short setups on the lower time frame. So what I'm about to show you is what we call full time frame alignment. Now, full time frame alignment, this is how you arrive to the conclusion that I have a bullish bias. What's your daily bias? I'm bullish. And that occurs when full alignment happens. When both the daily chart, higher time frame, and the 1 hour chart, the middle time frame, when they're both in the same direction, full alignment. Same is due for the bear side. Here's a chart, or explanation of a chart. We're going to get to a chart here in a bit. This area here is that point of interest. Again, this is your daily time frame. And this is your IRL. Now in the middle, what is your middle time frame telling you? Especially if we touch the point of interest, which we just learned is the IRL, and prices should come back to ERL. To confirm that in that full alignment, when that market structure shifts, and I know some of the ICT boys are going to say, go down here and do the CISD down here. You can have fun with that. I'm going to wait on the shift. I don't need to trade every day. I want to trade accurately so that we can work our way to a place where we can throw capital behind the trades and not just take every trade you see. Okay. And that's why sometimes in the actual live streams, you'll see me just waiting for certain things to happen and prices is all over the place because I'm waiting to strike. Going back to the chart, when this happens, the market structure shift, full time frame alignment, any sweep on sell side liquidity, you should be seeing a nice reaction. In that middle time frame, that's even going to give you PD raise, and you want to zoom in here to this area of price and go down to the 1 minute time to the smaller time frame. This area of price, smaller time frame, and apply the model. And that was full alignment. There's another way to trade when that's not there, and that's called state of conflict. State of conflict is when the middle time frame, the hour time frame, and the daily chart are not aligned. Maybe you have a bullish IRL or the ERL, and then you have a bearish chart. What do we do when that happens? When that happens, we only want to trade in the direction of the 1 hour chart. So if we're bearish, I'm going to sacrifice the bullish trades and be okay, very important, that if I was looking bearish and the market decided for whatever reason just to take off 100 points in the opposite direction, I'm okay with that because that opposite direction move, I had no probability behind it. So because I had no probability behind it, if I do these exact things, I'm going to have a 70% win rate. If I do these exact things, I'm going to be able to get to my next level in trading, right? But when we are in the opposite direction of the 1 hour, I'm showing you a chart, we reduce our size. We also prepare for shorter durations. There's times when the market, when everything lines up, I'm trying to go to take profit. I'm trying to go all the way to take profit. I might even hold extra contracts on my way to take profit. But when we're in a state of conflict at target one, I'm probably going to scale out the majority of my trade. Big difference. And that's why I want to align the contracts, because it gives you the best area and condition for things to continue to move in your favor. Now, this is an example of state of conflict. Day bias, daily BISTs at the bottom, ERLs at the top, and then here you're just in a downtrend. Break of structure, ERLs down, and left IRL. You got the whole bearish sequence. Now, whatever PD array you're using, the lowest time frame, this is where it gets over popularized too much. The lower time frame is just used for your entry model. The LTF is the only use for your execution. You're better off watching the higher time frames, so serious, and waiting for price to come into your point of interest, and then trying to trade out of that point of interest on the higher time frame, than to watch every 1 minute tick on the chart. Most people won't never really realize that, and you should write that down. That's a gem to keep in your notes. We don't use the lower time frame to create bias. I mean, you theoretically, some traders are at a point where there's a language amongst time frames. You can look at a 1 minute time frame, and depending on what the candles are doing, you can understand that that's a 5 minute engulfing candle. If you're at that level, maybe. But if you're not at that level, and again, we're teaching new people here, the 1 minute time frame, we're not deciding any bias. All right. If you don't have clear work on the higher time frame and middle time frame, we don't want to trade. Now the model, again, TRIL, time, rate, inversion, liquidity, the framework for a profitable model. We want to apply that to the lower time frames. Here's a snippet at what you'll be looking at. Now I know I've thrown a lot at you, but we're going to put it all together, and I'm going to explain everything like the way it's supposed to be. So sit back, relax. Now this is a blank day chart. This blank day chart, we're going to zoom in on it. And if you think you know how to analyze this chart, pause the screen, analyze the chart, and then come back. Okay, welcome back. Let's see. So for those of you that are new, just sit and relax. We're going to go through this. Here's a blank chart. We're going to use this chart in live trade example that was called out in live stream and executed in front of you. We're going to use this particular area, this particular chart, to do analysis. What's our steps? How do we analyze this particular time frame? 1, find a trend. Step 2, find a draw of liquidity in the direction of that trend. Step 3, you want to draw all of your PD arrays. And step 4, you want to find the points of interest with IRL to ERL theory. Because theoretically, what are my 3 things am I looking for? Draw of liquidity. That's really going to be confirmed by the trend and whatever lows or highs been taken. Trend, right? IRL, ERL. If I got these 3 things in the same direction, we cooking. Time to eat. All right, here's the chart. Here's that exact same chart, and we're going to use what we learned in lesson 1 to apply it here. Market structure has shifted. PD arrays are going higher, right? This is IRL. This is ERL, and then price pulls back into that volume imbalance. Price takes off. Price pulls back into what? Your ERL. Your IRL, your inside. And again, here's your ERL. That's your ERL. Okay. Here's what it looks like in cleaner form. But the draw of liquidity is higher. This is the impulse leg. This is the leg that sent this high. Sent this lower, started to downtrend. It's also the highest point. Actually, there's another on the side of the chart, like a little bit higher over there. The point of the matter is, in this area, this is the highest point right after an impulse leg. That's a draw of liquidity, in my opinion. Get a market structure shift. PD arrays hold, looking higher. Next, we want to move to the 1 hour chart. Okay. We move to the 1 hour chart. Whatever you draw on the higher time frame, the daily chart, be sure to overlay that over to your 1 hour chart. And then draw the PD arrays from that chart. We're going to apply the exact same things that we just talked about onto the 1 hour chart. Because what are we looking for? Draw of liquidity, trend, IRL, ERL. Okay. All those things. We want to get cooking. We want to get cooking twice. So this is the 1 hour chart. This is the IRL from the higher time frame. And up here is the relative equal highs in the ERL. Okay. Inside this chart, you'll see if you start to point out things. And again, if this looks new to you, don't worry. We'll be blending all these concepts throughout the course of this mentorship. I do have a few people that are completely new. So I wanted to build and start here first. But on this chart, you have a sweep of liquidity here, sweeping these lows into the IRL higher time frame liquidity. You have relative equal highs in the form of ERL. Market structure is higher, so I am bullish. I am extremely bullish. Everything I just explained here was pointed out. Coming into the day, you also had news. Took us higher, but we still left these highs in. Now on this chart, again, looking at the MTF, because this is the MTF, the middle time frame. Some people would argue, and you know, everybody can trade their areas and do what they want to do. But me personally, I'm not just going to hit buy because price is going higher here. Like this is where I'm banking on price to go. My analysis is telling me that this high, we're going to hit that high. Because I know that high, would you look at this time frame and just say, yeah, let's buy it? Where you going to put your stop at? How you going to get in? Where's your risk? You're going to risk down here and target up there? Unless you're going to swing trade. So we need different time frames to do this. Continuing here, we want to overlay this 1 hour segment, this segment here. You include these highs. We want to take that segment and move to the lower time frame. Now that we're on the lower time frame, we're mainly looking for models and areas of interest from the higher time frame. We want to use this time frame, especially this time frame in particular, the 1 to 2, the 3 to 4, and the 5. I primarily focus on the 1 and 5 minute, and mainly on the 1 to enter trades based off the higher time frames narratives. And I'm going to draw out and overlay the PD arrays that are here. There's that 1 hour BISI. This is that relative equal high. That relative equal high is the daily time frames ERL. That's the ERL from the daily. The daily has already taken IRL. We are delivering. This is what we say on audio. Delivery. All that means is somebody has some type of range, liquidity concept, where price is going from one end to the other end. On the daily chart, we're looking for delivery higher. So how can I get higher in this environment? This is the market open. This is the opening chart. How can I look to get higher? If I'm bullish on the day, the best thing that can happen is a run on sell side liquidity. There will be an upcoming lesson on liquidity. If you're new, just continue to watch through the lessons. You'll get there. Coming into the day, 9:30, I want to now have a plan. So now I can look at the higher time frame, the 1 hour time frame. I know I'm in the uptrend, daily time frame. I know the IRL, ERL concept. So now I have full time frame alignment higher. So because my time frames are aligned, I got framework. Man, I wouldn't want to try to trade this chart with nothing on it. I mean, you could. Me personally, I'm not just going to have nothing on the chart and just I'm going to buy. Some people can supposedly do it. I know that I can't. So without this kind of framework, what are you doing? So coming back to it, the best thing that can happen is a run on sell side liquidity. So again, this is the 1 minute charts range, right? This high took out this low, and this is basically the first change of character type low. When we're talking about manipulation and tactics that they use, but point of matter is this is the active range that's at work right now. Okay, so I'm going to be looking for price to sweep this range and go higher. When you see my chart in the morning on live streaming, you see stuff like this. This is what I'm expressing to you. And what happened on the lower time frame? We didn't come in to this area, right? Let's go ahead and see it. We didn't come into this area, but we got the sweep of the low. Now, this is the TRIL model. We got the 1 hour PD array down here. And over here, you got the higher time frame ERL. So now all I'm looking for is how is price going to get there? And that's the lower time frame. Lower time frame is going to tell me these smaller areas. I like to call them trigger liquidity, because once we sweep something like this, and especially when we get this, it's called a golden sweep. We'll talk about this inside of the course when we get to liquidity. But you get this entry model, which is inside of a kill zone or inside of a macro, this is the macro. You get our either inversion gap, breaker block, or my sweet spot model entry points. These are inversion gap and breaker block. Theoretically, they came from ICT, as we know, but that's debatable at times right now. Point of matter is, we sweep liquidity, have an opposite area of liquidity. Price breaks above, inverts here, pulls back, also called as advanced market structure shift, and that's your entry, taking off. And all we were looking for was price on a higher time frame to go up, pull back, go up. But we use this multiple series of time frames to come to a conclusion. Now, again, this is the wait, where's my mouse? Because I have this pin on. Sorry. I didn't realize that would happen. Now, this is the execution of it. That was the entry. And all targets get hit. All right. The way that trade moved would not have moved like that without the combination of time frames. This type of trade, I took very little drawdown, relatively quick delivery, relatively quick framework, high probability conditions. I feel confident. I'm not jumping into a trade, crossing my fingers. I'm not jittery. I'm not all over the place. I feel confident in the trade because everything is now aligned in my favor and I have framework. I don't think that most people understand that. When you line the time frames up like that, you got framework, and framework saves you from, it gives you something to work with and work against. A lot of what we do, and a lot of reason why the 90% of people don't pass this, is the emotional drawback and the ability to shoot at anything that they want to see. Having this in a way is like having a checklist. And in that checklist, it gives me the best possible conditions. Everything that happens, what I just explained, bang, 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 70%. Why would I want to trade anything else? So there's a couple things to take away. So number one, you don't need more than one time. You do need more than one time frame. Middle time frame is going to be your key. Find the trend, the draw of liquidity, and the ERL, IRL. If something's off in that framework, I'd be hesitant about trading in that market condition. And realistically, as a day trader, you shouldn't be looking to trade every day, every second, every move. You should be looking to trade the ones that give you the framework. When you have the framework, you have the probabilities. I don't want to trade in an environment without probabilities. You can have that. And last but not least, the lower time frame is only for the entry models. So I hope I have furthered your understanding with what we just went over, how I'm looking at time frames. This will be available to you, but there is a course outline too. So far, we've already tackled foundation. We've already tackled PD arrays, market structures. I'm looking to combine these two lessons as well, the market cycles and the macros timings. I'm going to be adding another lesson to this area here. After this is going to get where gold members are going to say, okay, now we're on a different pace. When we get to liquidity in part 2, we'll be talking about the LAF. Everybody's asking me right now about LAF. All LAF is a series of events that gives me the draw of liquidity. And when I have that, I use TRIL, TRIL, in the lower time frame to deliver that based off the higher time frames. When we get to part 3, we'll talk about using TRIL, the framework for a profitable trade, the models around TRIL, which is inversions, breaker blocks, the unicorn model, which is just a breaker block with a gap, and my sweet spot model, which is something that I came up with. And last but not least, we're really going to talk about risk management, trade management, and more importantly, back testing. If you are not willing to back test, I don't know what to tell you. You have to get, in my opinion, FX replay. That's one I'd recommend. I'm never going to recommend you to spend anything you don't need, but I truly believe you need a trading software, or you could find a way to journal your trades manually and discretionary save money there. But FX replay is a must. You have to back test. Don't believe anything anybody tells you. Back test it. Make sure you go back test it. Okay. And as we start to head out, guys, be sure to follow us Real Juicy Trades, the name across the board, except on StockTwits. If you have any questions and you're not inside of the group, because we are streaming to a big amount of people here on Twitter. What's up to everybody over there? If you're not involved in what we have going on, if you have questions, or if you just want to say hi, hey, what's up to me and the team, be sure to go ahead and email juicytrades with a G at gmail.com. Again, I want to thank all of you guys for your support. We are going to be cranking out the next lesson very soon. But going forward, all of these lessons will be only available inside of the chat room. I want to thank you guys for your continued support. I will be seeing all of you guys tomorrow on live stream at 9:15 a.m. And we're going to go ahead and have another great day, another good week. And I'll see you guys on the flip side. Now, I'm going to open up the doors for Q&A, but I'm going to end the recording here, okay? I'm going to open up the doors for Q&A. If you're new watching this, if you have questions, just dump them inside the main chat. Either me, myself, another member, or team leader will respond to you. Besides that, that concludes this recording. And again, I'll see you guys on the next lesson.